Welcome back. Hope you're having a good morning. For starters, the GIFT Nifty was suggesting a bit of a flattish to a mildly negative start of close around 40, 50 points. So they're about 60 points now is what we're bracing ourselves for. But plenty of stocks, a lot of action. Dipan Mehta, Director at Elixir Equities, joins us on the show. Hi, Dipan. Good morning. Good to see you. When few good earnings came out overnight, case in point being a Tata Consumer, though the stock has jumped up. And also we had positive numbers coming in from LTI Mindtree and Persistent System looked very, very good. Among the three, do you like any of them?
No, Nigel, none of them. If you call 2-3% type of a growth as good, I don't know, what is good then. So whether all the tech companies, the results so far have been disappointing, except maybe for Persistent System, there also eventually growth will slow down because of base effect and the uncertainty. So I think it's time to get extremely cautious on the software services company. And what is even more disappointing is that the management say that a 2-3% type of a quarter-on-quarter growth is a strong quarter. Means what has happened to the ambitions of the software services companies which were driven by entrepreneurial spirit? Now they are more than happy with a mid to high single-digit growth in sales. So I'm just very disappointed with the sector as a whole. And there are a lot of secular headwinds. This GCC is going to play a big role in reducing their growth rates. And of course, there is this entire sword of slowdown in US, which may affect tech profits. So we are getting more and more underweight on the software services side. There could be a few exceptions, companies which have a differentiated business model. But by and large, don't get enthused by a 2-3% outperformance versus what the analysts are expecting. And just because stocks are cheap. So I would still avoid the sector completely. Tata Consumer is good, but look at the valuation. I mean, the PEG of 6-7 times or so. You can't get solid money or get great returns or wealth, build wealth through Tata Consumers by buying at these levels. That's my conclusion.
Dipan, that's on Tata Consumer. Of course, today lots of other consumer companies are also reporting. Nestle is reporting, Lever is reporting. We all know, I mean, there's no growth there either. But, maybe they're not as expensive as they used to be. Would you look at any consumer stocks at all on the FMCG side?
Yeah. Good morning, Surbi. The biggest mistake I have made in life is to buy stocks which are cheap. And because they have corrected and valuations have come out, because the valuations have come out because there's something fundamentally wrong. And in the FMCG sector, a lot of categories have become mature. The growth rate, the underlying volume growth rates of many of the FMCG products is now linked to the population growth and not the GDP growth rate. And that's a very important distinction because you're in a country where you have a nominal GDP growth rate of 10% plus. Then why aren't these companies growing at 12-13% or so, or growing at 4-5%? That's a question you have to ask. And the reason for that is that the penetration levels have reached deep. All the benefits from getting into the rural areas is now over and done with a lot of these companies. And end of the day, I think consumer spending on FMCG products as a percentage of their income has remained static or gone down. And now there are many more avenues for the consumer to spend, be it in retail, travel, hospitality, healthcare, education. There are many more needs. And the Indian consumer has fast changed than what he was about 20 years ago.
I call it the mid-single-digit jinx, Dipan, because that's what this whole sector and many of these companies have been in the severe grip of, this mid-single-digit growth. Well,
Dipan, I wanted your view on a sector that could grow, though, going ahead. Dalmia Bharat. The numbers are pretty okay. I think after a few years, the last time we chatted, you were sounding at least a little bit more interested in the cement names. It's domestic facing. Cement prices have moved up. Input costs have come down. Q1 should be better than Q4. Anything you like from the cement pack? And if you had a closer look at Dalmia Bharat's numbers?
Yeah, Nigel, we are getting constructive on the cement sector. I think it's in a nice cyclical upswing after 2-3 years of downswing. And Dalmia Bharat being the fourth largest cement company certainly should do pretty well. Bit disappointed with the volume numbers because the growth in profits has come through lower costs. Typically, we want the volumes to go up in the cement industry to get more and more confidence in the sector. But yes, I think given the kind of construction activity and so many real estate projects have been announced, they should start getting into construction phase as well. And with the elections and all over and done with, execution also will pick up. So we are very positive on cement. The favorites over here with usual disclosure that we and our clients are invested are the Adani Group company, that is ACC and Ambuja. where they can squeeze out more efficiency, especially in ACC. And they're very aggressive when it comes to M&A activity. The group itself is a captive consumer, and they have great plans for these companies, and valuations are reasonable below the other larger companies, be it Ultratech or even Dalmia Bharat or Shree Cement for that matter. So there's at least a slight opportunity of a P getting re-rated higher. So generally positive on cement, I think, and I think that these two companies will outperform the rest of the market.
Valid thought, Dipan, and good to hear after a while you're getting constructive on the cement space with good reason, as you explained that to us. Stay with